Great discussion. Good afternoon, everyone. I'm Charles Payne. This is Making Money. So here's the deal. 2025 is going to go down as a year where we all second-guess Wall Street and the Wall Street Memo. And guess what? We're better off for it. Let's start with one of the most famous, right? The Wall Street Memo. They say, sell in May and go away. Well, we got 1 day left, and guess what? Not only is this an amazing May, but this is possibly going to be the best month for the market since November of 2023. So I hope you didn't listen to that one cliche. By the way, if these gains hold up, according to Ryan Dietrich, the next 12 months could be absolutely amazing. Look at the column all the way to the right. 31%, 17%, 29%, 16%, 19%. In fact, the average is 20%. That's absolutely huge. So I hope you didn't sell. Another Wall Street Memo. Always follow the smart money, right? They know what's best. I mean, these are the smart guys. Well, what did the smart guys do? They got extremely short this market, extremely short. And guess what? They are losing their shirt. And you see how this little part here is starting to curve back up at the end of this chart? They're starting to buy. If we hit a new high, that number is going to go exponential. It's going to go parabolic, and you are going to make a lot of money for not following the smart money. Well, another Wall Street Memo. Never buy stocks with high PE ratios, usually 23, 24. They say never buy those stocks. Well, that means you would have missed out on Palantir, which has a 210 PE ratio. By the way, 2025 gains, 62%. Mercado Libre, 50%. Zscaler is 43%. CrowdStrike, Netflix. They tell you don't own these stocks. You know, listen, there's a place for this kind of valuation stuff, but it should not be the main way that you determine your stocks. And, of course, the main thing on Wall Street, the biggest Wall Street memo of them all, always bet against retail enthusiasm. Now, I love this chart because you've got two things. The blue line is your Michigan sentiment number, which we know has been in the dumps, the second worst reading in history. The yellow line, though, is the Goldman Sachs social media number. This used to be a Twitter thing. I think Twitter must have sold it to them. And the yellow line mostly represents the excitement, enthusiasm you see, particularly for retail investors on social media, particularly X. Through the roof, they're excited, and Wall Street hates it. Wall Street hates it. And I got to tell you something, retail investors and the market, they simply don't care about reading or following these Wall Street memos. But don't worry, Wall Street will keep reminding them.
I got the memo, and I understand the policy, and the problem is just that I forgot the one time, and I've already taken care of it, so it's not even really a problem anymore.
Yeah. It's just we're putting new cover sheets on all the TPS reports before they go out now. So if you could go ahead and try to remember to do that from now on, that'd be great. All right.
All right. Follow the memo. I'm going to bring in Bianco Research President Jim Bianco. Jim, you know, there's so many rules on Wall Street, and it seems that, you know, it would be easy, like if all the rules on Wall Street worked, it would be like this, paint by numbers, okay? We fill this in with the yellow because that's what it says, and we fill this in with the red because that's what it says. I mean, it would be very simple to outperform the market and never lose money, but obviously that doesn't happen. So what gives with all of these rigid Wall Street rules and memos?
They're all based on the assumption that the market is in a certain cycle, that in this environment, these rules work. And they do until the environment changes. And usually the environment changes a lot more than people think. As you pointed out with some of the rules you've been pointing out with the May rebound and stuff, it's very possible that the April market is not the May market anymore. The rules of April don't apply for May anymore. And that's what's got everybody kind of all thrown for a loop.
Okay, so are there any steadfast rules or memos that you always abide by?
You know, it depends on the environment that we're in. If you're in a bull market, there are some rules. You know, there's an old saying on Wall Street, if you're in a bull market, here's the rules you follow. If you're in a bear market, here's the rules you follow. If you tell me we're a bull or bear market, I'll tell you which rules. But if I know if it's a bull or bear market, I don't need your rules in the first place.
Exactly.
And so that's exactly the environment we're in. But as far as the rules go, I do think, though, that you have to keep in mind that American capitalism remakes itself. And that whenever there's a bear market, I've always called it time, not price. The market will come back. The problem you have is, does it come back in 5 months? Or does it come back in 11 years? And that's really, but it does always come back because American capitalism has the ability to fix the problems that it has that caused the downtrend and remake itself and come back. And we might be seeing that happening right before our eyes in the last few months.
You know, I love that you said that. It is amazing. In American capitalism, you could even zero in on these American companies that have been around, find ways to reinvent themselves and always come back. And it's amazing to me when people are afraid to own those stocks. I'm like, listen, that company's going to be around long after you're gone. I got to get your thoughts on the legal news, the tariff stuff. There are a whole bunch of ways that, these are different tariff uses. So there's 301, 232 to 201. Do you see this as a speed bump? And what are you ultimately seeing with the tariffs? I'm thinking they're going to be 10% outside of China.
I agree with you. I think that this is a speed bump. As I understand it, what Trump did was he used the emergency rules to invoke tariffs now. The court said you can't use the emergency rules. But 201, 302, all those other rules, he can use those to get back to where he is or where he was yesterday in like 150 days. So we're eventually going to get back there. So if anything, it gives the rest of the world a little bit more time to say, you better cut a deal before we get back to where we were just yesterday.
Speaking of rules, a lot of debate about the message of the bond market. And again, we had this 45-year bull market, 40-year bull market, and it feels like maybe things are changing. Just your assessment of the message of the bull market. By the way, the uptick recently in inflation through Trueflation. Where are we right now?
I've been arguing that, that the cycle in the bond market turned in 2020, but that's not to be worried. I think what we have to understand is the normal interest rate in this environment for the 30 years around 5%. A lot of people look at 5% and say, oh my God, that's way too high. It's not. It's normal. That's why the stock market doesn't seem to have a problem with it. We have to stop thinking that zero interest rates and 2% on the 10-year or the 30-year is normal like we saw from 2010 to 2022. That was a specific period of quantitative easing and negative interest rates in Japan. And that era is over. Don't be afraid of 5%. Look at the 80s and 90s and 2000s. We had 5% interest rates during those, and we had big bull markets and big expanding economies. And we could do it again. You just have to adjust your thinking about the level of interest rates.
Yeah, a lot of people are going to get hurt if they're going to wait for those good old days that you just described. Jim, always a pleasure. Thanks a lot, friend. Appreciate it.
Thank you.
Oh, by the way,